Good morning, good afternoon, and good evening to one and all the TSB Nation. I'm Rustin Edwards, based in Geneva, with our illustrious recovering co-host, Mr. Matt Stanley, who's been on
Yes,
conference binge in Dubai.
the circus is over for the season, people. I'm pleased. No, it was MPGC this week, Middle East Petroleum and Gas Conference, hosted by our friends at Platts. Discuss. No, I've got some friends there. Or did after this. Uh, yeah, so that was the circus moved to Dubai this week, and the trading community landed in Dubai and didn't leave for what felt like a week. Look, I know every single time when I'm traveling, I'm very fortunate to travel and increase consumption for any jet fuel trader that's listening. I don't need to stay out until 2 a.m., 3 a.m. I know that. Don't sound like my wife. I know I don't need to constantly go out and see all these different people until stupid o'clock. And I know that I don't need to, I can only drink water. But I like the high road, people. Okay. I like variety is the spice of life, and the party's always on. But I flicked on the lights yesterday. You know, I was the only fat man left in the room that was dancing. Um, but it's over. And it's I've got one that's coming up in end of June, which is the PetChem conference down in Cartagena. But that's really it until APEC, I suppose.
What up, Posadana?
Huh?
Macedonia.
That's the shipping community. They don't like me. No, the marathon. I'm not going this year. I've got some other commitments, but we the Kepler and Marine Traffic. We've got a full contingent come and see our booth. What the guys are doing. So we'll have about 30 people there this year.
Good coverage, good coverage. Yeah, no, it's been a very interesting. From a conference standpoint, you have the kick off the conference year in London, and then you roll into Middle East, and then finish up in Singapore. I mean,
Yeah, well,
you got the 3 point prong attack there now.
roll is the right term to use there because that's what people were doing. They're just sort of ensuring there was sufficient gradient from one hotel to the other and just rolling me down the hill. No, I'm joking. No, it's been good. It's people are the conviviality is back of the community getting together and different parties, and certainly you've seen this year on Dubai. Just sticking with MPGC, it's not just your NOCs, it's not just your super majors. There's a big trading community now in the Middle East, and we actually had a party on Wednesday. You were invited, Edwards, but you're in Geneva. And we must have had
Was there in
120
spirit?
people. You were there in spirit. You were there in spirit. We had some TSB listeners, which were much appreciated that were there, and thanks for your feedback. And it was, it was busy. Our party, was really well attended, and and people are already looking at booking for next year. I would say though that the mood wasn't as enthusiastic as it probably was last year, and I think that's down probably to the fact that people aren't making as much money, and they're under a bit more P&L pressure. But the last sort of 3 or 4 years have been COVID, recovery from COVID, then the Russia invasion, which meant a whole different oil industry, trading industry was really born in Dubai, and now it's settled down a bit. The energy security issues around there. They're all discussions around Bab el Mandeb and Red Sea, etc. But largely, I would say people are like, oh yeah, not bad, doing all right. Yeah, everything's going all right. It wasn't like oh my god, I'm making billions. So
Well,
it was a calmer affair.
as we've talked about earlier on earlier podcasts, I mean, the issue that we have is there's been very little volatility in the price of crude or the other commodity prices as we move into the second half of this year of 2024. Believe it or
Yeah.
not, almost halfway through 2024. We've had crude trading, Brent has been trading in a very tight range. I mean, and it's been on a downtrend over the last 5 days, now at 81.25 for front month Brent, with structure coming off. And so
Yeah.
there's not a lot of bright spots when you start looking at how the volatility in the market's been trading. It's been very choppy, and I think that's what really gets a lot of traders, because a lot of traders aren't momentum traders. They like to pick a theme, stick with it, and ride it out and see how it works. And without having a real concise theme across the barrel, it makes it very hard for traders to make a good P&L. They have to work for
Yeah, I think you're right. I think that in a benign market, which it has been, um, or if you're open, well, it depends which which part of the circus you're in. If you're a trader and you want to take a position, and look at May so far, we've had a high of, excuse me, $85.89 on Brent, and we've had a low of, well, we're pretty close to it now. I think 81.05 has been the low. That's a narrow range, for the amount, the volume of trading that goes on just on the Brent market is ginormous, and a $4.5 range on Brent is, I mean, it's not, you're not gonna make a lot of money on the back of that. So, forming an opinion on where flat price is heading is very difficult for a trader if they want to put some size on. If you're an OPEC, however, in that room, you're laughing at them. You're like, ha, got you. Like between 80 and 85, if you're OPEC, you're fine with it. I mean, I know we've got the meeting coming up. I think it's what the where are we now?
June 1st.
June the 1st. That's a Saturday. Do they
Yeah,
meet on Saturday?
yeah, they do them on the weekend. Yeah.
Oh, and this one they'll probably want to say, yeah, we're definitely going to do something in the hope that the market wakes up Monday morning with probably rollovers of current cuts out through Q3, and maybe there'll be a little pop in flat price. Look,
Well, I mean, but I think that's the expectation right now. The market is expecting a rollover of the current cuts because, at the current supply level in the market seems to be heavy, seems to be oversupplied with crude. And
yeah,
so rolling over the current quotas and the current voluntary cuts, everybody's expecting that to happen. So I don't know if you get the price reaction. You might get the initial algo reaction on the headline,
yeah,
but then after that, the flesh and blood trader will come in and just say, okay, and we're back to where we would be.
yeah, I agree. And it's look, I mean, yeah, it's quite difficult to write about. The guys do it and they do it very, very well. So yes, look, we said November 2023 last year that we didn't see OPEC bringing back any oil back or change of policy throughout the whole of 2024. Like you said, we're nearly halfway through, and that certainly seems to be the way that things will go. And a rollover of the cuts out till Q3 officially is probably what will happen. I can't see Q4 being any different unless, I don't know, you never know what's going to happen. Another geopolitical situation or a change in global monetary policy, which again, I know we'll touch on, highly doubtful. But you look at what's happening in China. So China, since mid-April, Chinese oil stocks are up 30 million barrels. They hold an absolute level of about 940 million barrels in storage now, which is, again, a lot of oil. Yeah, okay. Seasonally, refinery ones have declined in China because it's maintenance season. It's that time of the year, Northern Hemisphere where it's the weather's all right. And people don't need as much, so maintenance season is upon us. But Chinese were relatively quiet during the first quarter of the year, and now they've started to pick that up a little bit. But again, it's not really providing the catalyst that it used to. Chinese oil demand is up, and people used to buy the market on the back of that in hope, and it's just resulting in a bit of a flat range bound market we're in right now.
Well, I mean, when you have Chinese demand up, you have them exporting a lot of product to the market because they don't really have the demand internally for the product demand. So
Yeah,
you have that counterbalance weight where, okay, we're importing crude, running our refineries, but we're exporting a lot of goods. Therefore, it creates a different picture versus if China was importing and not exporting, because then you'd have all that consumption inside the country, sparking
yeah,
a demand profile that's different. I mean, the only bright spot I see right now is the fact you have a lot of straight run fuel being imported into China. I mean, you had a big tranche going in on April, about 2.4 million tons transferred into China for the teapots, and it looks like another 2.4 to 2.5 million tons in May, which has actually been providing a lot of support to the bottom of the barrel on the residuum side. When you look at high sulfur fuel oil, which, if you were an analyst back in 2020 when the IMO changed over sulfur specs, you would think high sulfur would be dead because you'd have that much less demand against a large supply stance. But
yeah,
you now have an east-west that's pricing it, in the prompt. Yet you can't move an arbitrage flow from Rotterdam to Singapore in the prompt, but that's at 47, 45, $47 a ton. And the following month at $33 a ton, which almost points to an open arb to move high
yeah.
sulfur fuel, which, honestly, I would have think in 2024 that would not have happened.
Yeah, I agree. And look, one of the feedback that a lot of people gave on the episode last week was the split that is, the global bunker market of now who's buying high sulfur versus VLSFO. That's only, well, is it getting narrower or increasing if you're a high sulfur fuel oil supplier? Is there going to be enough? There's more. Yeah, look, it's
Well,
one that's got a lot of people's
to
attention.
me, it's a question: is there going to be enough that's commercially tradable versus is there enough supply?
Yeah,
Because when you think of all the oil that's currently being sanctioned or put under financial controls, a lot of it's heavy sour crude or
yeah,
heavy sour material. Venezuela, Iran, Russia, all heavy sour crude producers, which goes into the high sulfur fuel pool. And so, for a commercially tradable standpoint, it's a tight market.
yeah,
From an overall molecule standpoint, there's probably enough to go around without causing much of a problem.
yeah.
So it is that dynamic between what you can actually buy if you're going to abide by all the rules and regulations versus what you can buy if you're going to just be working in a non-compliant market or non-EU US compliant market. I don't want to
I
say that.
think, yeah. I mean, look, for the amount of all the data that we've got and the stuff that guys publish on research, what I would say has certainly picked up in terms of activity has been the amount of sort of media requests we're getting in, because it certainly seems like when we were fighting off, not fighting off was the right word, or we were trying to deflect, but we were kind of drinking from the fire hydrant at one point because there was so much going on. Russia was still going on, Sudanese issue, then Bab on Madeb happened, and then Suez Canal, what's happening in Gaza. Largely, it dropped off. The activity, of course, it always spikes, and I know you want to talk about that in a minute regarding container rates as well, because you can see that's a fair reflection of a decline, and what's happening is it's fairly leveled out, and freight rates have as well on tankers. But now the story is, or the requests are, so Russia basically, so Russia are still doing what they were doing before, even though there's all these sanctions in place, and it hasn't affected their exports one bit, apart from they can't go into Europe or the US. That's essentially what's happened, and now people are kind of like, so, there was a lot of concern about it. Energy security in Europe was what everyone was talking about down the pub. Now it's not. Now things have settled down, and the media outlets have kind of suddenly said, right, let's do a more investigative piece about where it's going, rather than, oh my God, now no one's going to have any oil. Where are we going to get it from? Things have really calmed down, haven't they, in the last sort of 6 weeks?
Well, I mean, I think they've calmed down over the last 4 or 5 months, to be honest. I mean, my favorite, to paraphrase, Jeff Goldblum from Jurassic Park, oil will find a way, and the
Yeah,
market have found a way to rebalance, and that's what's happened. So you've had the global rebalancing. Flows are flowing where they're going, and that has alleviated a lot of the supply crunch. And that's why I think the market's now come into a more sanguine malaise, is because the markets have all been rebalanced, and you don't have the supply shocks. I mean, you've got Russian oil displacing U.S. Exports, U.S. exports then going to where the Russian exports used to go.
yeah,
And so now you've got a completely rebalanced market. You throw on top of that the new refineries starting up in West Africa, Dangote, Soweto, and potentially Port
yeah.
Harcourt here the second half of the year.
And
Uh,
Dos Bocas in Mexico when that's up. Yeah,
that's going to increase even more products coming out. It's going to take away crude, but increase products. And so,
yeah.
you will have a global rebalancing. And I think that is still underway, but now it's going to be further impacting. And what you're probably going to end up with is a lot more distressed EU based refining assets that don't have a home to go with their excess oil.
And that's why last week we spoke about, and why I think it's so important to raise, without wishing to try and sensationalize anything, but why it's important to raise the seasonality of what has long been a seasonal event, i.e., this weekend, Memorial Day, the start of driving season. People are bullish gasoline. But then at the 1st of June, you've got the start of hurricane season. And like I said last week, why do I think it's so important this year? Because trade patterns changed and have now stabilized. If there is a disruption to the restabilization, I don't know what the market does, because it's like, okay, we had that big issue and then everything's all right. Fine. But now that's kind of, so now I need to find an alternative to the alternative. And I think that's a dynamic the market hasn't really faced yet. Like, since things settled down and readjusted. And I think that's why it's so important to watch hurricane season this year, because if the Gulf Coast refiners cannot supply Europe how they are now, we'll have to look further afield. And then the
Well,
energy security issue comes
but
back.
it depends if that's going to be a supply chain that still happens from the Far East, which is the main exporter of gas oil to Europe versus the U.S. So I mean that's always going to be a question. Speaking of hurricane season, NOAA's put out a prediction of 17 to 25 named storms this year, with 8 to 13 major storms of Category 3 or greater,
Yeah,
which is above the average they've had in the past. However, the one thing that is an interesting tidbit here is that um, as of right now, there has been no storm developed. And in the past, I think it was the past 6 years, there's always been an April or May storm that's developed ahead of
yeah,
hurricane season. So we've had a bit of delay coming in. Now,
yeah,
that can be contributed to the fact that you have a changing in weather patterns from El Nino to La Nina. And La Nina is supposed to be more favorable to storm formation.
yeah,
Check that with the higher temperatures of the Atlantic Ocean, and then you can have some really interesting, storm development that could happen. And now it's going to be a question of how much actually makes landfall into the refining basin. I mean, it's one thing if you have 20 named storms and they all sit out in the middle of the Atlantic Ocean,
yeah,
it doesn't really do much. But if you have one or two that hit Houston or Louisiana, that could cause a problem. And
yeah,
and it's not only, yeah, I know we're focusing Atlantic Basin here, but you also got to think about what's going to be happening in the Far East as well,
yeah,
because water temperatures in the Indian Ocean are very strong, which could point to large typhoon development in the Indian Ocean basin, as well as into the Far East basin, which could also import or impact trade flow.
yeah.
And
I'm just looking here. So I'm just looking here on last year's 2023 Atlantic hurricane season. It was the fourth most active hurricane season on record with 20 named storms,
yep.
tied with 1933. Okay, thanks very much. But there was one who hit land, and that was Idalia. Idalia. And that was, I know people in Florida buckle up for that time of the year, but still, you're right. Okay, if there's going to be nothing disrupted at all, U.S. Gulf Coast production or the refinery sector there, it was absolutely fine. And I agree with you. If it's going to be active, it has to be put into context. My favorite word. If it's just in the Atlantic, okay, there's not many people there live there. They're sure the most committed of setting up your own country, but it's what happens in the Gulf Coast that really is a problem. If it moves further northwest up into, like you said, Louisiana, South Texas, the whole Gulf Coast, the Gulf Coast, Mexico, etc. But yeah, last year was blowy, windy, but one storm caused any disruption in the US.
And just to take a look here, we'll throw that on the screen. Um, the ocean heat content. You can look right here where we are at May 23 and where it has been in the past, and where the mean is on the the average on the blue line. I mean,
Mm,
so the heat content in the Atlantic Ocean is high. I mean, so there is a lot of energy stored up in the water in the in the Atlantic Basin. And this is brought to you by NOAA, the National Oceanic
yeah, that one,
Air
that one.
Administration.
Yeah,
Excuse me. And so you can see that that it is hot, and so that could help drive the higher hurricane season and could cause problems going into the summer. But again, the proof
yeah,
is always in the tasting of the pudding, and
yes,
that pudding could be a damp squid at the end of as we're going into September and October.
yeah, yeah.
But
You're
it's
right.
something to be aware of, and it will impact trade flows. If you do get major storms, it will impact trade flow.
Yeah, I mean, we always ask you freight rates. Freight still okay, doing all right on tankers. I know you want to touch on containers in a minute, but how's things in a tanker environment?
Tanker and dry bulk are both fairly well supported at the moment. So you do have some good tanker rates, VLCCs anywhere between 50,000, 60,000 TC equivalents. Suezmaxes, 40 to 50,000 TCE equivalents are all good money for tanker owner and operators.
Okay,
Um, Aframaxes are also strong. The startup of the TMX exports, has
yeah,
taken a lot of Aframax demand and has rerouted freight positioning. So, that's opened up new trade flow that wasn't there before. So, it is a fairly strong market. And you've got, again, you have companies like Dangote exporting product, which is taking demand for LR1s and LR2s, as well as Aframaxes, Suezmaxes as well. So that's all playing very well into the support market. Dry bulk market, very supportive. But the one thing, as you've been intimating here, is that we've talked about interest rates and how we don't see any rate cuts coming in for 2024.
Yeah,
And one of the leading indicators I always like to look at is container rates, because container rates play directly into consumer goods, and which plays into PPI, which then translates into CPI, because that trades into how much more you have to pay for goods. And the one thing that I've been tracking and noticing is that, and CNBC actually put a piece out on it today, that container freight rates have been moving up over the last 2 to 3 weeks due to logistical constraints around different ports. When you've had the rerouting of goods that happened after the Houthis started blocking off the Red Sea, you
yeah,
had a spike in freight rates for containers because people had to reroute container ships, which made longer lead time of supply, which mean that there was some strain on this container market so other ships could be brought online to help alleviate the supply crunch because of the elongated supply chain. Now you're seeing issues where shipping companies are trying to maintain shipping schedules, which means they have more blank sailings and they're not moving empty boxes as much as they've had in the past, which is causing a buildup of empty boxes in the destination ports, but not in the supply ports, which is
right.
again causing a spike in freight rates. So just as I want to share from the website statistica.com, which kind of shows the leading indicator of container freight. Um, and we can see here that freight rates were coming off fairly strong after the post-COVID recovery. And
Mm.
then when you had here in December and January, when you had the Houthis starting to strike ships, you had a big spike in freight rates back up to about 40,000 a day for a 40-foot container. And then it
So
started,
this is US dollars per 40-foot container.
yes,
Okay.
which then tried to trail off as the strain in the supply chain started to get backfilled in with other vessels and other box boats. But then there's now been a recent spike here that's happened the last 3 days, and this has been caused because of weather congestion, lack of moving of dry, empty boxes back to the supply point where they can be reloaded to bring goods back in. And so this will translate into higher cost of goods, and it will translate into higher inflation, or at least stickier inflation going into the second half of the year. Um,
That's that's really interesting. Do you know what people hate is that they hate a sort of being blindsided because when the Houthis were striking and still are striking, um, across the shipping industry, was it dry bulk, cargo,
Tanker.
tankers? It was across everything. It wasn't the type of boat that was attacked. It was a boat that was attacked because it had a UK flag or whatever the reason was. People kind of saw that and went, okay, look, I understand that, it's too dangerous. Human lives are at stake. I'm going to reroute around the Cape of Good Hope. And that means it's going to cost more money. And that's going to mean that rates go up. I can justify it in my head. It's annoying, but I can justify it. This, they won't. The end user won't. You go, hang on. So you said that things are sorted now. You're going around the Cape, but suddenly if you go back to that chart a minute, the last week that they've got there in terms of a metric the aggregation, I think, of 8 routes is higher than when it spiked during the Houthi rebels. Yeah,
Yes.
look. So now it's okay. So the beginning of November, it was about what, $1,400 a box,
Yeah, let's call it that. Yep.
right? And where is it now? Over 4,000.
Last one landed for, yep, 4,072.
Okay. See, that's a 2.5 time, 2.6 time increase, on for a reason that you're saying logistically the containers just aren't there, and the reasons behind those
Well,
containers aren't where they
it's
should
a
be.
combination of containers not being there, shipping companies trying to keep their schedule intact so they can meet the demand of their customers on board, and you've had port issues that are popping up. Like in the United States, you have the ILIA, which is the International Longshores Association union contract expire. And now they're negotiating a new contract, which could cause slow down in port operations as well as potential strikes um, between now and September.
The Arthur Scargill factor strikes the what global maritime sector. Okay, fair enough. But yeah, look, I mean, it's really interesting. I certainly haven't seen this. I think a lot of people probably would be surprised as well. But when you boil it all down, I think you're right. And I think, my colleague wrote a really good piece yesterday about what's happening with inflation in the US. And this is a drum I know we've been banging on the smoking barrel, like, comment, subscribe, all year, has been we don't see any interest rate cuts by the Fed this year. And if I just go to highlight a couple of things I want to put into, to sort of highlight it. So the futures market probability of no rate cuts by December has gone from pretty much zero. It was zero in Jan. It spiked to 27% probability about 2 weeks ago, came off after the last meeting, and now has gone back up. And it's about a 15% chance that the market is pricing in that there won't be any Fed rate cuts. I'd buy that all day long. I would buy that all day long, and I want to see what that's pricing at in terms of volatility on the options market. But just to start, just want to give the first three lines of what Reed says. Continued US economic resiliency led by ongoing strength across the consumer will keep inflation sticky in a range between 3 and 5%. And the Fed is unlikely to cut rates this year. I think we agree. We've said that. Obviously, Reed's got a lot more data than we have at his disposal. But what does that mean? What does that mean for? Okay, in terms of it's not going to give the boost that people were hoping for. Flat prices under pressure on the back of all this because people are starting to realize it all now. Hence why we're at a sort of 4 or 5 month low. But it also translates in what it means for products as well, right? For the diesel consumption, it should weigh on what happens with diesel demand and maybe end user demand in general. I mean, what do you think?
Well, it will. I mean, when you think of diesel demand, this data points that we've had out this whole last week on the PMI information out of Asia, Europe, and the United States all show that manufacturing PMI is still suffering, and service level PMI is carrying the ball right now for the entire
Yeah,
market, entire global economy. And service level PMI is not something that actually is a source of any type of diesel demand because it's services. It's not manufacturing. It's not trucking. It's not shipping. It's people sitting behind a computer, talking about, hey, where do you want to travel? What do you want to do? Shall I schedule you a plumber?
yeah,
Restaurants, things like that, which don't intensify any type of real consumption of energy. And so, with that in mind, yeah, you have a lower demand for diesel, which then starts weighing on the market. Gasoline demand, okay, there's a lot of questions about gasoline demand going into the summer. I mean, when you talk product stocks and ARA, they're at an all-time, they're a yearly high, which is
yeah,
very
yeah,
unusual for this time of year. I think
yeah,
they've increased up 2% week on week.
yeah,
A lot of that's in the gasoline as well as the naphtha. I think the only product that drew was gas oil. But that could be attributed to a lot of refinery turnarounds and some maintenance that's still going on in ARA. But as we
yep,
come out of the turnaround season and refinery runs start to ramp up, we could be looking at a very flooded product market going into the summer, which is great for the consumer because that will help alleviate some of the pressure on the consumer market.
yep,
But it doesn't really bode well for refining margins nor for oil major P&L when you're looking at it from that standpoint. And you throw on top of this that we're going into an election year, and so there's going to be some real pressure on the Biden administration to try to keep energy prices as low as possible going into the summer.
yep,
We already saw that with the announced release of the strategic gasoline storage in the United States, so 1 million barrels being liquidated out. Now, the thing is that is a mandated release by the Congress. It's not a release that the Biden administration decided to pull out of their hat and say, hey, we're just going to put this out in the market to alleviate gas prices. It was part of the budgetary controls, I believe, from 5 years ago. Maybe it was 4. But anyway, it was something that was agreed to in the U.S. budget because the strategic gasoline stocks have just become too expensive for the U.S. government to maintain and hold. And it's
yep,
only 1 million barrels. And so there was a mandated release, which it gave the the executive branch, the flexibility of when they released it, but they had to release it. They had to sell it. And so the Biden administration has taken advantage of that going into an election year by selling it out and getting rid of that storage position. But again, that just puts another 1 million barrels into the market, which is roughly about 15%, 20% of the U.S. demand for gasoline in the region that it's going into, which
When
is
do you,
in the Northeast.
yeah, I mean, look, just before we close up for the week, but at what point do you think the market says, okay, I'm going to agree that the consensus is inflation will be sticky. We don't see any Fed rate cuts. I'm going to look at other definitive metrics from what my outlook is for crude oil prices, because lots of people at the start of the year, like I said, that 0% chance that there won't be any rate cuts this year is now jumped up to 15%, but I think it's a lot higher than that once we see the next Fed meeting results. At what point does the market move on from global monetary policy to looking at the supply and demand fundamentals and what's actually going on? I think it has to be that point, right?
Well, yeah, it has to. I mean, and because you still have diverging thoughts on supply and demand. I mean, you look at the OPEC supply and demand, you would think that, oh my God, we're going to run out of oil because their demand figures are so strong.
Mm,
Yet you look at the EIA and the IEA, they've been revising their demand figures lower every time they release a monthly report.
yeah,
And so what we probably are sitting in is a market that is really balanced at the moment. Supply and demand are probably equal.
yeah,
Uh,
I agree.
if not, maybe demand might be slightly higher than the global supply, but nevertheless, it's fairly equal.
Yeah,
Um, and so I think that's the thing that the geopolitical headlines have been driving a lot of the price action, not so much the S&D. Because in reality, the S&D is starting to overtake the geopolitical. We're seeing that with crude structure. I mean, crude structure at one point was almost up $2,
that's right.
and
Yeah,
now
it's
it's
really come off, isn't it?
it's
Yeah,
come off
yeah,
massively, and it's come off massively down the entire curve.
yeah,
Um, so I mean, that's kind
absolutely.
of where your volatility has been sitting in, is in the low VAR, large size trades that can be done on time spreads versus outright flat price. And now that's starting to liquidate because people realize, okay, there's plenty of oil out. We might actually go to a contango market at some point.
Yeah, maybe.
And when you look at DFLs, it's already, when you actually look at dated frontline versus Brent, it's actually showing the contango market.
Yeah. Okay. Well, look, I think we put the worlds to rights again this week. I certainly have for several vital organs of mine. So,
Well, we won't be having a broadcast next week as there'll be some traveling going on, but we'll be back at the beginning of June with a post OPEC report. Um,
yes,
and looking forward to second half of 2024.
yes. Ciao.
Everybody click like and subscribe and thank you all those who have been supporting us going forward, and we look forward to meeting you all at the various conferences we're going to be attending around the world. Irene, hats off to you for putting up with
Yeah,
us,
yeah,
and
absolutely.
we will chat to you all later.
Ciao.